So today I'm going to be talking about M&A in social casino, and a lot kind of touched upon some of the numbers already, but we're going to go through them in a lot more detail. So, want to address a couple things here. Number one, why has there been so much M&A activity in the sector? Number two, what are the key attributes to some of the successful deals? Key underlining themes for consolidation. Will M&A theme continue, and who will be the future buyers? How the smaller and private companies can position themselves for M&A, and some of the key industry macro themes impacting the future of M&A in social casino. So here's kind of a visual overview of some of the transactions that have taken place over the past 5 years. 2011 saw really the first big deal between Caesars Interactive acquiring Playtika. Then in 2012, we had IGT acquiring DoubleDown. WMS at the time acquiring a company called Phantom EFX, which became their social casino platform. Aristocrat acquiring Product Madness. In 2013, you had Caesars again acquiring Buffalo Studios. Zynga acquiring Spooky Cool. They are the studio which essentially has produced all their slot games. 2014 again saw Caesars and Playtika making another acquisition, this time Pacific Interactive. You saw GSN acquire Bash Gaming, Bally Technology acquiring Israeli company Dragonplay, and then Churchill Downs acquiring Big Fish. In 2015, some of the big deals were Crown acquiring DGN Games, Stride Gaming acquiring Infiapps, Imperius acquiring Akamon, and then so far in 2016, we've seen GSN acquire Plumi, Giant Interactive acquiring Playtika, and then Penn National Gaming acquiring Rocket Games. So quite a busy list, and these are just some of the bigger deals. There have been smaller transactions as well. So as Alad mentioned, there's been approximately $7 billion worth of M&A over the past 5 years, and this includes, of course, the big $4.4 billion mega sale of Playtika to a Chinese consortium owned by Giant. So M&A deals, typically over the transactions that we've covered, and we have a list of around 15 to 20, the average multiple for the upfront component is around 5 to 6 times trailing EBITDA, or 2 to 3 times trailing revenues. Again, this is just the upfront component. There's typically an earnout as well. As you saw in the prior slides, it's a very top-heavy industry. There's been a lot of consolidation, and now there's very few private companies with meaningful scale. Top 10 companies control 74% of the market. Top 5 companies control 55%. So some of the key factors which impact the valuation, there's a few in no particular order. Number one, revenues, the growth rate of those revenues, and product diversification. Then, of course, profitability and whether or not you're at scale. Talent, R&D, and the platform, both the front and back end, are certainly a consideration. The revenue mix between mobile and web is very important. Geographic revenue concentration, certainly a key item. Your existing game portfolio as well as your pipeline, and then KPIs. And the KPIs we typically look at are DAUs, the monetization, both ARPDAU as well as revenues per paying user, retention rates for D1, D7, and 30, paying player conversion rates, very important, LTVs, and then cohort data and the trends along that cohort data. So, question number one, why has there been so much M&A activity in this space? And, to us, the number one reason is revenue predictability. Social casino has a very long and sticky curve. There's very few genres in mobile gaming that has this and these attributes. In fact, we think there's really only 2 sectors that have long-term sustainability: casino and strategy and RPG games. If you look at the grossing charts, you'll see lots of casino games in there, and then the other games you'll see, of course, are strategy RPG games, okay? Slotomania, here's a chart. This is the history of the revenue history for Slotomania since it launched. Very, very predictable, amazingly predictable for social mobile gaming to have this type of revenue curve continuing to be growing after 6 years, and is the biggest game in the industry. Another reason, it's an immediate and meaningful opportunity for traditional gaming companies, RMG companies, to go digital. There's very few opportunities in the U.S. for land-based casino operators as well as suppliers to implement a digital strategy. We do not have legalized online gaming for the most part in the U.S., and so social casino is seen as a alternative for a lot of these companies to go digital, show a digital strategy to their investors. Another reason has been the synergies and advantages for the gaming equipment suppliers, as Alad mentioned. Proven land-based content is a real competitive advantage in this industry. So IGT, Scientific Games, Aristocrat, they're taking their land-based casino slot machines and they're applying that content to their social games and leveraging their real-world portfolio of content. The math in these games are all patented and owned by these companies, and these types of games prove to do very well and monetize very, very well. So that's another reason why you've seen, a big reason why you've seen a lot of the land-based equipment suppliers enter and do M&A in this space. And then finally, economies of scale. So consolidation, the reasons you've seen Playtika make so many deals is there truly is economies to scale, especially around UA as you get bigger and bigger. So here I've tried to categorize the different M&A waves that we've seen over the past 6 years. The first being kind of the early mover advantage. Caesars acquisition of Playtika for roughly $103 million, arguably one of the best deals ever done in all of social mobile gaming. You saw the return here, $4.4 billion, so an amazing deal. It pays to be early and have a correct sector call, and this is a prime example of that. Another kind of key theme wave was all the gaming equipment suppliers entering in the space, getting social. IGT acquiring DoubleDown, WMS acquiring Phantom EFX, Bally acquiring Dragonplay, Aristocrat acquiring Product Madness. So here, again, key theme, already talked about it, the suppliers leveraging their technology and land-based content into digital. Another theme we've seen is acquiring Rng Talent. So here you have companies like Zynga acquiring a studio, Spooky Cool, with proven land-based, with developers who have real RMG content. So Joe Kamikow, famous land-based slot developer, co-founder of Spooky Cool, Zynga acquiring that company specifically. This was a talent acquisition. And Playtika did something similar when they acquired Pacific Interactive. This was a studio with many land-based, many developers who had previous land-based experience. Another theme we've seen is the operators getting into social gaming. You've had Churchill Downs acquire Big Fish, Crown Resorts acquire DGN Games, and then most recently Penn National acquiring Rocket Games. And here, again, it's a way for them to expand their digital strategy as well as to try cross-sell and penetrate their existing user base. And then the final theme is the Chinese buyer. We think we're going to see more of this, but Giant, acquiring Playtika. These are deep-pocketed investors, and the question here is, are they going to bring social games into Asia, a market right now that is quite small for social casino gaming? So just some notes on the Playtika deal. It was, it's a fascinating transaction in many respects for its size, how quickly it was done. The headline number, $4.4 billion, that was all cash. The multiples worked out to be roughly 13 times trailing EBITDA, 11 times on 2016. So again, quite a big premium to some historical transactions. But again, if you've looked at Playtika's track record and success, certainly a huge testament to the team and what they've created and done. Again, major validation for this industry. The risks, though, of course, there are some risks with any transactions, is maintaining the entrepreneurial environment, the team, the culture. Can they hold on to their very dominant position? And then again, the key questions looking forward is Giant going to help them expand into the Asia market, specifically mainland China? Mainland China, one of the biggest mobile game markets in the world, but really immaterial right now for social casino. A couple themes impacting the industry, which will have an underlying impact on M&A. Number one, there are signs of a maturing market, and this is especially noticeable in DAUs. So the chart here on the left has DAUs for the biggest public companies, and you can see plateauing and even declining for a couple of of the major suppliers. DAUs, acquiring DAUs is becoming more and more difficult. That doesn't mean revenues is declining. The other output, the other variable for revenues is ARPDAU, and as you can see, ARPDAU has been increasingly improving for a lot of these companies. So even though the user base has been flattening out, industry has still been growing, largely via monetization, but in terms of the addressable market right now, certainly some signs of it maturing. Another key theme is again, Alad touched on this, increasingly complex and challenging UA market. It is in many respects still the wild, wild west out there. The two big ad networks, obviously Facebook and Google, have a dominant position in the market and take a lot of publishers' budgets in terms of their UA spend, but there's many third-party ad networks, and there's a lot of concerns around some of these third-party ad networks in terms of their role, data leakage, traffic fraud, who owns the data and control. And so these are all questions that not only social casino publishers have to consider, but certainly many others. And it's very, very expensive to market in this sector. As everyone knows, the secret is out to the size and profitability of social casino, and with that you see very, very high CPIs, perhaps higher than any other industry, which makes it, again, very, very difficult for new incumbents. That being said, there's still ways to succeed in this market, and we've kind of outlined four ways in our mind. Number one, innovation. We think Merca is a prime example. This is a company that has taken some RPG elements and incorporated into a slot game and has done very well because of that. Product niche. This is companies like Rocket Games, where they've capitalized on a theme, the classics theme, 3 real slot games, again, done very well, sold recently. Geographic concentration and exposure. Fa from Product Madness, targeting Asian players in themed slots, has done very well. And then reward games. This is incorporating real-world items, and that's done and executed very well by Play Studios. So again, also has been quite successful. So to summarize, there's been a lot of M&A activity over the past 5 years. Some of the key themes be early mover advantage, the gaming suppliers leveraging their content, gaming operators entering the space, acquiring Rng Talent, and now some very deep-pocketed Asian buyers. Acquiring assets has been attractive for a number of reasons. Like I mentioned, the revenue curve, the LTV associated with social casino games is very attractive. It's a very immediate and large digital opportunity for many US gaming companies. And then there's the economies of scale. As I mentioned, valuation is impacted by a number of factors, including revenue growth, profitability, scale, and KPIs. A lot of questions about the Playtika deal, but certainly have set a new standard in the market and helped validate the legitimacy of the social casino industry. And even though it's very, very competitive today, there's still room for success, and it's been proven by companies like Merca, Rocket Games, Super Lucky, and more recently, Huge Games. Looking ahead, we still expect more consolidation, but the deal flow is certainly going to slow down. In our mind, we're going to see more and more buyers emerging from Asia. So that is my talk on M&A. Happy to take any questions now.
Do you see trends that we see in the RMG world, like VR or fantasy sports, coming into the social world?
VR is interesting. I think someone asked that in the last session. The problem is with the underlying user base for social casino, it is an older demographic. They're not necessarily the first adopters. But that said, I think there is some opportunity. Last year in my presentation, it was on bold predictions for social casino, and one of them was incorporating VR for social casino games. I think you could make a very immersive, interesting environment, and this is a sector that has proven to monetize. And so for when you start out, finding a game genre to monetize early on VR is going to be very important. And so I think there's some opportunity there. Probably agree with Alad saying, poker might be a first place to look. But I also think you could see that with slots as well. And I would also point out in the land-based gaming industry, they've created some games now called Sphinx 3D from IGT, and this is a holographic image. And a lot of people, oh, this game's not going to do well. It's done very, very well, very popular on the casino's floor. So you do have an older demographic now playing, a 3D type of game. And so I certainly think there could be demand, and again, it could open the market to new users as well. And in terms of DFS, I think the theme there would be the incorporation of skill-based games. Okay, so skill-based games in the RMG world is a big topic. A lot of companies trying to do that, capitalize on incorporating skill-based games into a slot machine, which is by definition, random. Can you do it? I think it's difficult, but again, I certainly think that it's ways to do it, and I think that's how companies, if you're to break into this category now, you have to think outside of the box. You have to be creative. Merck, I like to use an example, right? Taking some of the characteristics from another genre, RPG elements, incorporating into a slot game. So think incorporating skill-based elements, putting it into a social casino type of game or environment. I don't know exactly how it would look. Could prove to be successful.
I was going to ask about you mentioned the factors you look at in M&A deals, and one of them was the mix of mobile versus PC-based revenue. What are you looking for there, and what kind of trends do you see?
Well, you want to be looking for mobile because the PC web-based gaming business is, flatline and declining. It's in a secular decline as people from web are transitioning over to mobile. And so really it's important to find, not necessarily a requirement, but certainly you're going to get a higher multiple valuation if you're going to show the majority of your business mobile first game company. And you'll see a lot of transactions today are more around that. That was earlier in the days when there was a closer mix between web and mobile. But now I think, you're seeing more and more companies that are mobile, and that's, the correct focus.
Let's give Adam one more round of applause.
Thank you.